Views expressed are solely those of the speakers and do not represent this show or its team.
There's always a reason to be pessimistic, right? There's always that wall of worry that's out there.
Yep.
And bears and bulls make money, pigs get slaughtered, all that kind of stuff. But over time, bulls make more money than bears. And so prudent investing with an eye towards risk management, we're gonna do good. We're gonna be able to accomplish our financial goals in the future.
Welcome to Built to Last, conversations on wealth, work, and life. I'm Wade Lopez, joined by our Chief Investment Officer, Gary Aiken. Gary, welcome back.
Great to be here, Wade.
Yeah, so we're at halftime, man. In the first half of 2026, didn't go exactly like most everyone scripted. The S&P 500 reached a new high. Inflation moved above 4%. Oil spiked. The Fed started talking about raising rates instead of cutting them, and the market still gained about 8 to 9%. Today, I want your honest read on the second half of the year, not the Wall Street consensus, but what the data says investors and business owners should expect between now and December 31st. Gary, let's set the table. Does the first half of 26 look like a foundation for what's coming next, or are we living on borrowed time?
You know, Wade, I don't think the markets have a cancer diagnosis or some kind of terminal illness. I don't think we're living on borrowed time. I think we're living in a great timeline where we should all have long, equity-driven return lives ahead of us.
Before we talk about where we're going, let's be honest about where we've been. First half of 2026 delivered returns almost nobody predicted. Corporate earnings were strong, forecasts moved higher, and Wall Street now expects S&P 500 to finish somewhere between 7,800 and 8,000 by end of year. But the headline doesn't tell the whole story. The average company in the index fell as much as 21% at some points this year. So while the S&P 500 held up, the gains were far less evenly distributed than they appear. So Gary, walk us through the honest first half scorecard. What went right, what went wrong, and what surprised you most?
The interesting thing is that, about half of the sectors in the S&P 500 outperformed the S&P 500 and half the sectors underperformed. Certainly technology was a great place to be. But even within technology, there was some problems, right? Software underperformed while semiconductors and semiconductor equipment, was clearly the star. But we had lots of great companies doing great things throughout, and that's why we ended up with about a 10% return for the S&P 500 in the first 6 months of the year. Outside the U.S., markets were up as well. So developed markets, emerging markets were all positive. We had a good first 6 months to the year in bonds, as you talked about, yields up, prices down. But we came into the year with higher coupons than we normally would have in years past. And so bonds were more or less flat. A good start to 2026.
AI spending is driving much of this year's earnings growth. The 4 largest tech companies plan to spend $725 billion this year. That's up 77%. And AI-related companies account for roughly half of the S&P 500 earnings growth. So, Gary, when one theme is carrying that much of the market, what does it tell you about the health of everything underneath of it?
I think it doesn't tell us a whole lot about the strength of the other companies. If 7 or 8 companies are doing this, what does it tell you about the other 492? I don't think it tells you that much. I think you have to look at each of these companies individually and see what they're doing and why their stocks are moving the way that they are. I think what it does tell you is that those companies were clearly outshining everyone else and therefore, got re-rated higher a couple of different times during the year.
Moving into this next topic about oil, it was at 112 in April because of the Iran conflict, accelerated inflation, and it kind of took Fed rate cuts off the table. Oil has since pulled back toward these, pre-conflict levels. How much of the first half story was geopolitical noise versus actual structural market behavior.
We saw the geopolitical conflict play into market dynamics in a couple of different ways. Certainly, we got the excess volatility that we had been talking about in March after the war started on February 28th. And so for those 30 days that the war was really going on the first time in earnest, we saw markets draw down. We saw strength in the dollar. We saw weakness in foreign currencies. We saw people selling gold, selling bonds, selling whatever they could to get US dollars. We saw oil spike, as we said. And so as we look at the second half of the year and we see the war in Iran, starting back up in earnest,
Right.
One of the things I want to point out is, we've restarted the clock on the War Powers Act. And so, 60 days from the time that the war started will be September 10th. 90 days, the outside date is October 10th. And of course, we have elections about 30 days after that in the US.
Yes.
So we have to think about the war in the context of what does it mean for oil? What does it mean for volatility? And what does it mean for the US election cycle as well?
The Shiller Cape ratio crossed 40 in January, and it hit 41.6 by May. That's the second highest in over 140 years, right? So that's not a timing signal by itself, but it is context. Are these levels heading in going to be the same, lower, higher, going into the second half of the season?
Yeah, I think what it means is two things. One, valuations have gotten a little stretched. So, here we are, deja vu again. We said that at the beginning of the year. We're saying it at the half point of the year, which is, hey, valuations have gotten a little stretched. We think investors ought to think about valuations. The way we think about it is just, normal rebalancing within portfolios. And in terms of sort of valuations overall, there's an expectation that earnings are going to grow to support those valuations. And so the other thing that we're going to be looking for in the second half of the year is that these companies that have gotten re-rated higher, that they are bringing in revenues and earnings that are supportive of those valuations. And secondly, I think the other offshoot is that what we've been saying for a while is that, hey, at some point in this AI revolution, a lot of other companies that are not quote unquote tech companies are going to start experiencing the benefits of AI in their bottom lines. And so we would expect to start to see some of that. And that will be confidence boosting as well in the second half of the year.
Yeah, and there's a handful of things you're going to determine what it looks like, which first, the Fed. I think 9 of 19 officials now favor raising rates before year end, and the market is pricing in a possible September hike. That would be a major reversal for investors who started the year expecting rate cuts. Seconds inflation, CPI reached 4.2, and producer price rose 6.5. Lower oil prices may help, but inflation in services and housing and consumer goods continues to be stubborn. Third is AI. The first half was about spending heavily to build the infrastructure. The second half will be about providing that investment. And can it actually produce revenue? So, Gary, of those three variables, Fed policy, inflation, and AI earnings, which one carries the most weight for what happens to markets between now and the end of the year?
I think it's AI earnings. Like you said, the tech concentration in the S&P 500, the proliferation of AI spend amongst even companies that aren't tech companies, seeing some ROI on that is going to be the most crucial thing. Like you said, the Fed probably on hold, inflation going to hover around current levels. We don't expect too much from either of those. If we get sort of non-events on those two, it's obvious that the AI one is the one that's going to affect market valuations and price movements.
Cool, I agree with that. So let's walk through each of those scenarios, though. Look like what do they look like in terms of real market impact? If oil stays low, inflation moderates, and the Fed pauses versus inflation, which could prove stickier, and the Fed hikes in September and markets reprice. what does each path actually mean for a portfolio? Like the IPO pipeline for the second half is extraordinary, right? But what does that mean now for each portfolio?
Yeah, I think let's start with oil because you started there, right? Our viewpoint may be a little contrarian, which is that we generally think as our base case that oil is going to be elevated for the foreseeable future. We think that the idea, the Pollyannish idea that Iran is all of a sudden going to roll over and play nice and change their ways. I think that's like I said, I think it's Pollyannish. And so we think that, there's going to be issues in the Strait of Hormuz for the foreseeable future. So
Yep.
I think that means that marginal oil supply will not be transversing the easiest path. And so you'll have a little bit of a higher price for oil. We think that energy companies are probably good places to continue to be in. They had a good first part of the year, and then as oil prices came down, they came off again, and oil prices are going back up, and they're having a good run again. But we think higher profits, higher dividends, and less and a sort of a volatility dampener against the AI story. So that I think that's one place to start.
Yep.
In terms of tech. I think the spending continues, but the spending may be disconnected from the price of stocks. And so we think that, like we talked about valuations wise, we're at high valuations to start the second half of the year. A pullback in some of these names, even as the spending continues, is probably something that investors should anticipate. But if the spending continues and the stock prices go down, I think they're good chances for us to buy more shares in great companies.
Second half is going to have some new potential, right? In the IPO pipeline, we've already seen SpaceX, OpenAI, and Anthropic are all, I saw some discussion about Anthropic again today. And those are going to be potential listings. We've seen what SpaceX done, which you predicted couple shows ago. It's kind of, I think, it did exactly what we maybe went a little higher than we initially anticipated, but it fell below value. So what does a wave that's this size? I mean, that's the largest, obviously, in my lifetime. What does that do to an existing portfolio allocations in the market dynamics?
Well, SpaceX will be coming into indexes, much later this year. And so, there'll be some index buying of it. Again, there'll be a lot more releases of long-term owners' shares coming into the market to dilute it. I think the most interesting ones are definitely going to be the OpenAI if that resurfaces, and Anthropic IPOs, because we'll start to get some numbers. And like you said, the whisper numbers from Anthropic are that revenues are growing. They are actually profitable, which we heard from OpenAI that OpenAI was not profitable,
right.
But Anthropic was theoretically profitable to the tune of almost $1 billion in the first quarter or the second quarter of the year, and so that's a real company earning real profits, which of course I love profits. No shame about that. And so I think if we get some numbers out of Anthropic that show what the spend is, what the diversity of that spend is, what the visibility on additional spend is, that's going to trickle down to, all the compute manufacturers, all the memory producers, all of the people building data centers will say, "Yep, we got to build more data centers, and that means we're going to need more of more gas turbines and more light bulbs or whatever it is, more screws. It filters down through the rest of the economy, and so that'll be really important. But I think that I'm fairly bullish on that one.
Yeah, and market broadening was definitely a theme, right? But it was a theme heading into 26, and it held until the Iran conflict kind of snapped, right? So it's back to a handful of AI names. Does the second half look like continued concentration, or genuine broadening out in the sectors that have lagged or been kind of behind?
I think that the laggards are probably going to continue to lag, and the winners are probably going to continue to win. That
Okay.
that's that's my guess. Now there may
Okay.
be some companies that were laggards that can catch up a little bit,
Yeah.
and we'll be looking for those stories in every industry and sub industry. There seem to be winners who are continuing to win, and I don't see a lot of stories where there are turnarounds that are sort of being affected. Um, and I think that there will be a broadening out. That's been one of our themes. And in fact, as we're speaking, I think the equal weight S&P 500 has actually overtaken the market weight year to date. So,
Wow.
one of our things at the beginning of the year was that we thought there would be a
Yeah.
broadening out
Yep.
from the concentration of last year.
Yep.
But I think some of those Mag 7 names that haven't done as much this year, we could see some of those start to outperform in the second half of the year as well.
Yeah. I would agree. Let's get specific. So, Gary, what do you see as far as, real opportunity in the second half for investors? Where do you think investors are not paying enough attention right now when it comes to risk?
I think investors have gotten a little bit exuberant and have forgotten that sometimes stocks go down. Every year, once a year, we have at least 5% pullback. Every 2 years, we have a 10% pullback. Every, 3 or 4 years, we have a 20% pullback. And
Right.
so I think that, we got a little bit of a pullback in March. I wouldn't be surprised if over the summer we get another pullback. And certainly since it's an election year, there's going to be stories about stuff going on into the election, and I think it's reasonable to assume that stocks will have a hiccup at some point, between now and the election, but being generally bullish, I think those are good times to buy stocks.
Okay. So, tech and semiconductors, they've been, the dominant story. Memory chip companies have seen triple digit prices increases. And the Philadelphia Semiconductor Index just posted its best quarter on record. At what point does the semiconductor trade become crowded enough that the risk profile completely changes?
I don't know. The risk profile of the semiconductor index has changed much. It's always been very volatile. It's always been one of the most volatile parts of the S&P 500 and of the global stock market. This has been an area where there have been booms and busts, and the booms and busts are very pronounced. It's a high-tech commodity at some point. And you can overproduce GPUs and CPUs just like you can overproduce copper and oil and any other commodity.
Yep.
It takes a lot. It takes a little, maybe a different skill set to manufacture it versus buying it out of the ground. But it's it can be a commodity at some point. So
Right.
I think investors need to recognize that.
Right. I agree.
Beyond semiconductors, there's so many opportunities and so many other great companies that are doing great things that you don't have to just be in semiconductors to make money.
Well, let's talk about some of the boring things that typically are boring, because power and utilities are the sleeper story, right? I mean, extremely well. Industrial companies are reporting 300% earnings growth in power-related businesses driven by data center electricity demand. Is this a structural shift in how utilities are valued, or a cyclical trade that reverses when data center construction slows down?
Utilities really haven't done that much. They're one of the lagging sectors of the S&P 500 through the first 6 months of the year, only up 7.5%. That being said, hey, 7.5% plus the 3 or 4% dividend, nothing to shake a stick at, right? Like that's great. I'll take 10 to 11% in a utility. Like you talked about, industrials, we think that industrials related to the AI story are still things where, we're going to be building data centers. The data center build out is a longer term thing that requires permitting and requires all kinds of other longer dated things to happen. And so that story can continue for a while, and those companies can continue to be profitable and generate cash flow. And also, there we'll get back to the war. And there's two wars going on. There's a war in Ukraine. There's a war in Iran. And we think that industrials in the defense sector are also going to be in high demand.
Well, energy pulled back from its conflict-driven peak. So the case for oil in the second half rests on peace negotiations progressing and supply somewhat normalizing. What's your read on energy as an investment for the rest of the year? And what is the scenario where it surprises to the upside again?
Yeah, I think our thesis in energy is that oil is, probably not at the $55 to $60 level, but is probably in the $75 to $80 level for the foreseeable future. What does that mean? It means we've already seen rig counts start to go up. So companies are responding. They're producing more oil at a higher price.
Right.
If you produce more at a higher price, theoretically, your profits should go up. That means there's more cash to distribute to shareholders. Maybe the price of the stock goes up. Maybe it doesn't. But what we look at there is it's a volatility dampener, right? If we have this barbell in our portfolios where we have, like we talked about, the semiconductors, which, yes, a lot of growth, but a lot of volatility. And we can offset that maybe with owning energy companies that maybe not a lot of growth, but a lot less volatility. And so when one goes, it's been incredible to watch. As one goes up, the other one sort of stays here. As one goes down, that's when this one responds positively the other direction. And so when we talk about sort of portfolio construction, that's how we're approaching sort of dealing with risk in the second half.
Healthcare and biotech have largely been left behind in 2026. So that historically creates an interesting setup. Is there a rotation thesis here, or is there underperformance, a reflection of something more structural that I'm not aware of?
Yeah, healthcare was, one of the best performing funds for I don't know how long was the Vanguard Healthcare Fund.
Yeah.
And when we saw it in client portfolios, we said that was a great choice. For a long, long time, healthcare was the sector to be in. I think a lot of that changed with Obamacare and some of the changes to the healthcare system and the way the healthcare system is incentivized and taxed. I think one of the things that we talked about maybe last year and the year before that was, at some point the federal government is going to try and get a hold of the cost curve in healthcare for Medicare and Medicaid. That's going to mean that there's going to be a crackdown on health insurance plans, on medical devices, and all that kind of stuff. And I think just sort of the healthcare area hasn't really recovered from that, or is in a structurally different place. Biotechs are very hard to deal with. It's almost like a crapshoot. And so we generally, I don't have that kind of expertise. I don't have a team that has that kind of expertise.
Right.
I'm very bullish on that in general, because AI is going to enable firms to go in and mine all kinds of data and come up with new drugs. I don't think it's an issue that we won't have new drugs, or that the health of America and the world won't get better. I think it's just a hard place to invest and make money because it's just really hard to pick winners. That being said, there are some winners that we think will continue to win around weight loss, and then companies that are using AI, where we can identify that they are using AI to their benefit to cut costs. Those are going to be areas in healthcare that we think are going to be profitable for investors.
Yeah, makes total sense. Let's move into my favorite topic, bonds. So with rates elevated, potentially moving higher, the Fed reducing its balance sheet over time, where should someone who holds fixed income be positioning going into the back half of this year?
You know, the 10-year as we sit here is about 4.6%. The 30-year bond is about 5%.
Mm-hmm.
So we've had a backup in yields as we predicted. I don't want to say it's time to sort of lengthen duration. Maybe from a tactical standpoint, it might be exciting here and there.
Yeah,
Maybe the price of oil comes down. Maybe we get some readings on inflation like we got in the month of May here.
right.
Or I guess June PPI was low. June CPI was low. But you didn't see sort of the long end of the bond curve,
Yeah,
do much around that.
yeah,
So the way that I would think about that potentially is if we're range bound, maybe mortgage bonds are a better way to play that rather than coupons. It's an area that we've generally not been active in the
yeah.
past, but for lots of mathematical reasons, mortgage bonds in a time when interest rates are going to be relatively in a tight band can make some sense. That being said, we think that the general trajectory of interest rates is higher. And so
Yeah.
we want to be short duration, keep it for dry, keep our bond portfolios for dry powder for when, stocks go on sale.
My bonds are treasury money markets, right? So there we go. Nah, I'm just kidding. I let Gary tell me where to put my bond money, which is usually treasury money markets. So he doesn't have to hear me complain about it. But
That's a
anyway, I
smart
digress.
choice, Wade.
Yeah. So we talk about these things. Forecasts matter. I get it. Right. But what really matters is what it means for the people listening. So are long-term investors wondering whether to stay the course? Should they be making changes? And business owners, they're deciding whether now is the time to invest, acquire property, or hire. And some have been sitting on way too much cash, waiting for the market to have just the right moment where they can jump back in. So, Gary, for the long-term investor who is up between, I don't know, 8-15% on the year so far, depending on their allocation, is this the moment to rebalance, take some chips off the table, or hold exactly where they are?
No, I think for the long-term investor, rebalancing periodically is something that you just do. That's part of prudent investment management. It's something that we do for our clients every
Yep,
day. For the
agree.
clients who have been in cash and, like you said, been in cash for far too long,
Yep.
I think given that I think that volatility is going to be increasing over the next over the first part of the second half of the year. I think dollar cost averaging probably makes more sense if you're going to get into the market. But
Mm-hmm.
the best time to buy stocks is when you have cash,
Right.
because over every 3-year, 5-year, 10-year, 15-year period, you
Yep.
generally make money in stocks. And so the best time to buy stocks is when you have cash. For business owners who are making decisions, I think it's crucial to go and look at your assumptions, look at your cost of capital.
Right.
And if you think that the project that you're looking at investing in
Mm-hmm.
has a rate of return greater than the cost of capital, it's probably worth doing.
Let's stay with the business owner, like that have capital to deploy right now. So, and a lot of my clients do, right? So, what does the second half economic actually say about that decision? Is the cost of waiting higher than the cost of acting in an environment, or does the real uncertainty around rates just make you sit still for a while?
I don't think there's a lot of uncertainty about rates, frankly.
Okay.
I think I wouldn't anticipate that rates are going to drop much if they do. So
Mm-hmm.
waiting for lower rates is you're going to be waiting for a quarter point,
Okay.
maybe waiting for a half a point over the next year.
Okay.
You're going to lose more to inflation and the cost of the things you're trying to
Right.
buy than you will
Right.
to how much you're going to make up an interest rate.
We just had a similar conversation about real estate can sometimes, especially if you're in the STR market, you can wait and lose opportunity, right? When it's time. And I feel the same way about a lot of the small business owners that we're talking to right now.
I think the other thing to remember is that during the pandemic, there was a wave of 5-year, 7-year loans
Yes.
that were made, and
Yes.
those are going to start coming up for renewal or refinancing. So if you're a small business owner and you're thinking about doing something with new money, don't forget that there's going to be a lot of pressure at banks going on, and so getting that money today, getting it assured and lined up is it may take longer than you expect, and so you probably want to get that done sooner rather than later.
I agree. I've seen in the last 90 days, especially, as much as 2-point shifts. So that's a big cash flow difference, right? When you're having to look at it from that standpoint. And I guess for me, speaking of cash, how I am, I like treasury money markets better than I do bonds for the most part, even though I know it's the same. You know what I mean? On the short-term yield curve. I feel safe. We're in Virginia, helps out a little bit. So at what point does sitting in cash start to cost you something in a market like this that could have meaningful upside? How do you have that conversation with someone who's been on the sideline for over a year now? How do you have that conversation?
I tell them to think about their cash, not as something that they've just got there. It's a useful asset, and so if they have a use for that cash that is near term, that it's a 3-month reserve, or they're going to buy a boat, or they're going to buy a house, or they got to put the kids through private school or whatever it is. They have a relative who has medical issues that they know they need the money for. That's fine. It should be in cash. That shouldn't be subject to market fluctuation. But other than that, sitting on cash for fear purposes is not a smart thing to do. And instead of sitting in it because you don't want to put it all in the stock market, that's a time to have a conversation about what your risk tolerance is.
Right.
And an honest conversation about your risk tolerance. And we can find a way to be, 50-50, 70-30, 80-20. We don't have to be 100% in stocks with the rest of that money, but sitting in cash and not in corporate bonds or other instruments that could earn more, even municipal bonds. Right. At tax advantage yields of 5 and 6%. Versus your money market at 3, that money adds up over time. And so the compounding error means that, 5 to 10 years down the road, that vacation house may be unattainable, that you want. You may not be able to give as much to the charities you wanted to give to. So I think that's the way that we have that conversation for sure.
Let's bring this thing home. We covered the halftime scorecard, the variables that decide second half, and what the specific sector opportunities are, what it means for all the people making real financial decisions right now. As always, I have 3 really tough questions for you. This is pretty tough, but you're going to have to get out on a limb here. What is the single most important thing that matters right now for how investors should be thinking today?
I think the single most important thing is, can I handle the amount of volatility that is potentially coming down the road? Am I going to freak out if my stock portfolio is down 20% in the month of August? I'm not saying it's going to happen, but it could.
I would agree. I'll just leave it at that. So I want to ask the next question before I broaden that. What are you watching most closely over the next 6 months that every person in this audience should have on their radar screen right now?
I think every person in this audience should have the election on their radar screen.
Good one.
I don't think that they need to freak out about it, but just be cognizant of it, that there's going to be more noise, there's going to be more headlines, And so when those are out there, they're not surprised by it, they're not shocked by it, and they don't change their long-term thinking based upon short-term market fluctuations around the election coming up.
Yeah, tone out the noise and stick to it. So last question, what's the one mistake you most want our listeners to avoid between now and December 31st that doesn't have anything to do with noise?
Yeah, I think the one thing to avoid is the hot IPO. I I know that there's a lot of temptation to get in on the ground floor, but like we talked about in our IPO episode a few episodes ago, there's going to be plenty of time for you to buy that company if it's going to succeed. And there are people who bought Apple and were in the wilderness for 10 years while Apple did nothing but sort of go down before making its historic run where everybody made a ton of money in Apple. The same thing, just you don't have to be there on day one to make money.
Yep. So here's what I think I heard, and you correct me if I'm wrong before we finishes out. Interest rates, probably not going to see a rate decrease in the very near future. I heard the market is probably a pretty good place to stay in, diversified, continue to your strategic portfolio. But most importantly, I heard there's a lot of opportunity that's different than it was maybe a year ago, different sectors and things that like look at the opportunity when something goes bad, look for the opportunity, right? So I'm very excited about this. I think that I see maybe more opportunity than I thought having this discussion with you right now.
Yeah, I think there's always a reason to be pessimistic, right? There's always that wall of worry that's out there. And bears and bulls make money, pigs get slaughtered, all that kind of stuff. But over time, bulls make more money than bears. And so prudent investing with an eye towards risk management, we're gonna do good. We're gonna be able to accomplish our financial goals in the future. Stay the course.
Halftime reports are useful. They tell us the score. They tell you, what's working and what's not, and they give you a chance to adjust before the game's over. But the investor who comes out ahead in the second half probably not necessarily be the ones who correctly predict what the Fed does in September. They won't be the ones who think they know. More than likely, they'll have a plan. They'll stay disciplined and they'll not allow the noise and the headlines to change it, right? The uncertainty Gary just discussed today is real, but uncertainty is not the same as danger. And a complicated market is not necessarily a broken market. In fact, Gary just showed us a bunch of opportunities that we can take advantage of over the next 6 months. If today's conversation raised questions concerning your portfolio, your financial plan, our team at Concord Wealth Partners is here to help. Gary, fantastic conversation as always.
Thanks, Wade. Let's make some money in the second half.
Let's do it. And thank you guys for listening. If you've enjoyed today's conversation, please like the episode and share it with a friend or a colleague who may also find it helpful. That is exactly what we call this, Built to Last.
This podcast is produced by Concord Wealth Partners, LLC, an investment advisor registered with the Securities and Exchange Commission. Registration does not imply a certain level of skill or training. The information presented is for educational and informational purposes only and should not be construed as personalized investment, financial, tax, or legal advice. Nothing discussed should be considered a solicitation or offer to buy or sell any security or investment product. All investing involves risk, including the potential loss of principal. Past performance is not a guarantee of future results. Individual results will vary based on personal financial circumstances, risk tolerance, and other factors. Concord Wealth Partners does not provide tax or accounting services. Tax and accounting services are offered through Concord Business and Tax Advisory, an affiliated CPA firm. For more information about Concord Wealth Partners, including our Form ADV Part 2A and Form CRS, please visit concordwealthpartners.com or contact us at 800-838-4370.